Welcome back to the channel. As you already, I'm sure, know and seen for yourself, Tesla stock was up almost 7% on Friday. And I think something just materially changed structurally in this market. And I want to discuss that here in this video. I will, again, highlight some of the biggest catalysts for this week. We went over these things in more depth in the last video. If you have not seen that, check it out. I actually think a bit of a short squeeze could be coming for the broader markets and for Tesla stock. Specifically for Tesla, we could see a large short squeeze. A couple different reasons for this. I understand I could be a little bit early. We are heading into a seasonal period of weakness. And that's why the economic data is going to be so important. Just the fact of the matter is, if we get good economic data, we're probably not going to get the seasonal weakness. If we get bad economic data, recessionary economic data, we will probably get some weakness. Okay. Assuming things go well, which I think should be the assumption, I think Tesla goes through a very large rally over the next couple of months. And I think it could look like a short squeeze, and I think part of it will be a short squeeze. But a large part of this rally that I see coming is based on interest rates. It's based on sentiment and positioning. And I'll explain that in this video. It's something you critically need to know. Like, this is not a video you need to skip, okay? We're going to be talking about some deep stuff here, okay? And it's vitally important. With that said, I will also share the latest from Tom Lee. He has been one of the most correct fund managers and research-based firms on this market in the past couple of years. And he says stocks have a lot more upside from here. In fact, he says the S&P could end this year around 680 to 700. You know what's funny about that? My prediction was back in May, as we had come off the lows, but we were still at like around 550 on the SPY. My prediction was 700 on the SPY by the end of this year. You could go back and find some of those videos, and it's wild to see all of the hate and all of the negative in the comment section of those videos. Sure as shit, we are around 650 today. We're only about 8.5% away from 700 by the end of this year. It is in sight. But what Tom Lee says, I think, is very important, because Tom Lee says this market, at least the upside from here, he says that, in fact, instead of maybe some of the areas that have led this market in the past couple of weeks, maybe we see small caps and financials and some of the cyclicals and AI names that carry this market higher. Let me put it to you like this. If Mag 7 is not leading this market, 8.5% of a rally in the S&P with small caps, financials, cyclicals, and some of your adjacent AI names is huge, massive. Okay, that would be a massive broadening out of this market. Now, if Mag 7 is mainly leading this market higher, that's not super impressive to get an 8.5% rally. But I think this broadening could occur. So first things first, ladies and gentlemen, let's get down to the basics, okay? For earnings in this upcoming week, we are going to have NVIDIA Wednesday and after hours. There could be a little bit of nervousness on Tuesday around this. Now, I think starting off Monday, we don't have a ton of economic data. Really, Monday and Wednesday are the slow days for economic data. And Wednesday, we have NVIDIA earnings. So, like, that's going to be a big day. Monday, tomorrow, is going to be the slow day. Okay. Wouldn't be surprised to see a continuation of the bullishness we had on Friday. Okay. On Monday. Like, that would not surprise me whatsoever. Okay. Just to see the continuation. Markets, really love what they heard from Powell. Like, this was a pivot from Powell. Like, Powell says that most likely tariffs are going to be a one-time price increase, that he thinks it's unlikely that we have lasting inflation from this. That is huge. That we have not heard that from Powell before. I think this is the 2022 Jackson Hole equivalent. Like 2022 was the bearish Jackson Hole. 2025 Jackson Hole is going to be seen as 2-3 years from now, like that aha moment. I should have been bullish. Like the writing was on the wall from Powell to be bullish. Okay. Among many other reasons to be bullish, the Fed has been an obstacle at times for this market before, and I think that's going to be less of an obstacle going forward. But again, that could be the same narrative that drives markets coming tomorrow, a continuation of what we had on Friday, because there was a lot of people that were nervous, a lot of people that were hedging, a lot of people that sold stocks on Friday, but really all of last week in anticipation for Jerome Powell. That's why I was so bullish for Friday. I said, look, guys, there was a 0% chance the Fed was going to be more hawkish than expected because of the data that we got in the last couple of weeks after the last press conference, and the fact that Wall Street was so nervous heading into it. Like there was a 0% chance, in my view, the stocks were going to go down on Jerome Powell's speech. Okay. Now, I felt the most likely outcome was some kind of neutral Powell, an unchanged Powell. But I did assign around a 15 to 20% chance. I forget exactly what I said, like 15-ish, 20% chance that Powell would be neutral-ish with a slight dovish tilt. That's what happened. So the best case scenario from Powell actually happened. And this caught everyone's positioning offsides. And that's why you've seen the Russell go up 4%, right? And some of the most heavily shorted stocks and hedged stocks like Tesla in particular just absolutely explode on Friday. So I wouldn't be shocked to see that continue on Monday. And again, Nvidia earnings on Wednesday are going to be very important. We have a lot of other earnings as well: Marvell, Dell, Alta, Centennial, Affirm, Gap, Umbrella, Thursday and after hours, Dollar General, Best Buy, other retailers like Dick's Sporting Goods and Ali, Thursday pre-market, Snowflake, CrowdStrike, HP, Viva, Pure Storage, NetApp, a lot of other AI names, Okta, okay, MongoDB, like bunch of AI names, bunch of retailers, again, AI names, and Nvidia this week. So that's going to be a big catalyst. As far as economic data, again, there's really not much on Monday. Some small regional data sets, new home sales, but nothing that's going to really move the markets too much. Tuesday, durable goods orders month over month. You're expecting a really negative number, so instinctively, when expectations are this low, there's a greater chance for an upside or bullish surprise. That's going to be big data on Tuesday. Again, Wednesday, you don't have much of anything. On Thursday, GDP growth rate, second estimate. I'm not expecting that to move much. So again, that will be a big catalyst if we do get a change, but I don't really see a change. Maybe we come in a little bit stronger than 3%. Maybe the bounce back's like 3.1 or 3.2%. Is that going to move markets or really change things? Probably not at this point. Now, Friday, you are going to get your big data with core PCE. That's important. And honestly, the expectation is roughly the same as last month, which I think is probably pretty accurate. If we do come in on the low side, that's obviously good. If we come in on the high side, that's obviously not great. Personal income expected to come in a little bit higher than last month. That would not be ideal. Is it the end of the world? No. Personal spending is going to be one of the biggest data sets because that is 75% of the economy. Okay. And if people are spending money, that's great. That means growth is great. Things are doing fine. Okay. So we do have a lot of big economic data mixed with Nvidia earnings. This week is going to be volatile. Let's establish that. In terms of a short squeeze on Tesla, we'll get into that in just a moment. But first things first, beyond just a short squeeze, I think there's, again, the fundamental justification for Tesla stock to dramatically rally from here. Because you have this environment since Tesla's earnings, it's the weirdest thing where retail has gotten bearish on Tesla. Institutions have gotten really bullish on Tesla. They've actually already started the process of covering short positions. They're taking on more bullish bets on Tesla. Like there's kind of some weird things going on in the institutional land versus retail. Normally retail's the bulls leading things from a sentiment perspective. This time around, it's not really the case. Now, that's going to flip-flop, of course, in my view, in the next couple of months. But that is going to lead to upside positioning. Now, also hedge funds and institutions, they're not looking at Tesla like an AI company. And over the next couple of months, it's going to be obvious that they have to start paying more attention to Tesla as an AI company. As I talked about in one of the prior videos, again, for simple math's sake, let's say Tesla does $100 billion in revenue this year, okay, which is roughly where we're going to be. Let's say over the next year or two, Tesla does $10 billion in robotaxi revenue for a year. Let's say that's a 70 times multiple, or 70% bottom line profits. That's $7 billion to the bottom line divided by 3.3 billion. That's $2.12 of EPS. That is more than what we're going to have for this year. That's probably similar to what the EPS will look like for next year. Who knows? Again, how fast does robotaxi scale? That's going to be a big question. My point is, a little bit goes a long way as far as robotaxi revenue, as far as AI revenue. Like $100 billion in robotaxi revenue. Let's just like do some shits and giggles math here. Okay, $100 billion in robotaxi revenue at, let's say, a 65% margin. For an example, Meta's like 85% net margin. Like, that's why Meta's so profitable. Okay, let's say 65%. That's $65 billion in profitability divided by 3.3 billion shares outstanding. That is $19.69 of EPS. Like, dollar for dollar, robotaxi revenue is going to be far more profitable than Tesla's business today. Okay, times that by like a 200 times multiple, something like that. Boom, you have Tesla stock at $4,000 per share. Okay, crazy numbers, but you get the idea. As rates start to come down, and now we're pricing in damn near 3 rate cuts by December. There's a 37.8% chance of 4 rate cuts. As long as we're getting rate cuts because inflation is falling, growth is holding up, in that scenario, Wall Street's going to start saying, hey, instead of looking at next year's revenue and earnings for Tesla, we're going to look at 2027 and 2028 and justify this, raising price targets and getting allocated to Tesla. As rates fall, for the right reason, time horizons get extended. So what I'm actually calling a short squeeze here, I do think in part will be a short squeeze, but I do think it's one of those short squeezes that, let's say, could send Tesla to $450 or $500, but then that starts a new base level. Like, it's not one of those short squeezes where Tesla goes straight up, comes straight back down. Okay? I think with this next squeeze higher that we see, be it a short squeeze where shorts are covering on short positions, but also institutions are now bullish on Tesla stock in the options market. It's obvious to see short sellers are already starting to cover on short positions. But as retail investors start to get more bullish on Tesla as well, it's going to be a short squeeze mixed with what could be a bit of a gamma squeeze and an overall repositioning back into Tesla. Okay, which starts a base at a higher level. Think about like Carvana or AppLovin or even a Palantir for that sake, right? That has went through these short squeezes and it kind of sets the stock at a higher level. Like it doesn't really come back down. It's not one of those just up and down moves. Part of that basing out, part of that we're going to go up and kind of start a new level. Maybe we consolidate from there and then move higher again in 2026, something like that, is because of interest rates coming down and the ability to lengthen time horizons. As I've said before on this channel, Tesla was a $400 stock in 2021 because rates were at nothing and the time horizons were extended out. People were looking out 4 or 5 years into the future and justifying where Tesla stock was trading at that time. Obviously, things, changed a bit from there. But I find it crazy that Tesla is a $341 stock, even versus 2021 when it was $414 and all the progress we've seen. I also think at a kind of baseline approach here that Tesla's AI ambitions are far larger and that the progress that we're going to see with Tesla's AI is far greater than what Wall Street is even pricing right now. So how you really make money investing in markets or single stocks is you have the priced in expectation, whatever that is for any given stock or anything. Use Jerome Powell on Friday as an example. Like, there was this baseline being priced in, okay? Well, you don't make money if priced in happens, okay? You just don't. If we're all expecting, Nvidia is going to report $40 billion and they report $40 billion, the stock's not going to be rewarded on that. It's priced in. It's widely held. Now, if Nvidia comes in at 35 billion and nobody was really expecting that, wow, that's a big downside surprise. Nvidia is probably down 15% on that. Okay. If Nvidia comes in at 50 billion, nobody was expecting that, let's say, stock's probably up 20%. Okay. Take that same kind of analysis or that thought process into Tesla right now. Wall Street has nothing essentially priced in for Tesla's AI, for robotaxi, okay, for AI even into the future. Like, it's not really something that's looked at seriously within Tesla at this point. Well, as we start to show larger proof of work and more scaling of this technology and actual revenue that starts to materially come in, and let's say thousands of rides that start to take place. Like, imagine that headline that comes out here soon that Tesla has completed 5,000 robotaxi rides, paid robotaxi rides for that matter. You don't think that's going to move Tesla? It absolutely will, because there's nothing priced in for this. Okay, so we're going to be exceeding expectations. Okay, and that's where you can get this larger follow through to what I view will be a short squeeze into the end of this year and into 2026. Now, over the next 6 weeks, I think Tesla can do very well, but it also depends on the economic data, whether we go into a growth scare or not, okay? And also Nvidia earnings, because if the markets just tank because it looks like we're going into recession, like, is Tesla going to go through a short squeeze or is it going to rally huge? Let's just be realistic. No, okay? That's why with single stocks, if you're a single stock investor, you always have to look at the single stock itself and what the story is, what's priced in, what the narrative is, positioning, all this other crap, the news for that specific company. But you also have to incorporate the markets if you're looking at a shorter term time horizon, right? If we're in a bull market, stocks are going up for no reason, it doesn't take a whole lot of good news to get that company to also move up, if any news at all. Now, versus you have a weak market, stocks are falling, then even if that company is giving you the best news, it's not going to be rewarded, okay? Unless it's like massive, game-changing kind of news. Now, again, when it comes to a short squeeze, we have 2.63% short interest of free float. For a company like Tesla, that's huge. That's $24.29 billion sold short in Tesla. As I've said before, short sellers have already begun the process of covering on short positions. Short interest of free float is down about 9% in the last 3 months. The dollar amount sold shorts down about 12% in the last 3 months. And really, short sellers have almost no appetite to go out and short Tesla. The shares out on loan is down 34% in the last 3 months. The amount of shares sold short is down 11.5% in 3 months. Okay, down 11.5%. Short sellers have covered over 10 million shares in 3 months. Okay. Whereas, again, retail investors have grown more bearish on Tesla in the last 3 months. Ever since Tesla's earnings, something has really flip-flopped. And I think going ahead from here, not only are you going to see short sellers covering on short positions as rates are presuming to fall 3 to 4 times, 2, 3, 4 times by the end of this year, and even more so into 2026, you're going to see retail investors that start to get back on board and get bullish again on Tesla. That I think is going to happen. That I don't think is going to be too difficult. But what you're also going to see is, these are firms that have short positions in Tesla that maybe were not that bullish to begin with that are getting more bullish. But think about this from an average hedge fund or institutional perspective, whether they like or don't like Tesla in general. A lot of firms are underweight Tesla. Tesla is the most underweighted Mag 7 stock, meaning Tesla is like 5% of the S&P. Take Google for an example. That's like 7% of the S&P. So if a firm, which most firms are, underweight Tesla, maybe they have 2.5% of their portfolio in Tesla. Maybe they're, 50% underweight in Tesla versus the SPY, okay? They have 2.5% of their portfolio in Tesla versus 5% Tesla, making the makeup of the S&P, okay? But maybe instead of, being neutral Tesla, they are overweight Google, let's say. And Google's 7% of the S&P, so maybe they have 9.5% of their portfolio in Google to make up the difference. Now, why is that important? Because all hedge funds and institutions, virtually all of them, track the S&P. They have to track the S&P. So you have the beta to the S&P, right? They want as close to a beta of like 1 as possible, right? They want to track the S&P so they don't lose, right? Like everyone compares their, money managers to the S&P. But what they do is they go out and they get that alpha to get that outsized return. That could be that small cap, that crypto, whatever the case is. Well, Tesla may start to attract more firms to be neutral weight in Tesla, or maybe overweight in Tesla. Maybe some firms take down their positioning in other, stocks like Google or Apple or Microsoft, and they start to put more into Tesla. So I see that as an upside as well in the coming months, which fundamentally could, help move Tesla stock higher. Now, I don't know about actual, prices or the time horizon on this. The technicals look really good. I think Tesla could easily be in the mid 400s, if not 500 by the end of this year easily. And I see a very large rally and really euphoric market coming for 2026 as well. Now, before we go ahead and conclude this video, take a listen to what Tom Lee said about this market.
A record high following Fed Chair Jay Powell's remarks this hour, signaling a policy adjustment. Joining us here to unpack what we just heard, Tom Lee, head of research at Fundstrat, chief investment officer of Fundstrat Capital. Good day to be a bull like yourself, Tom.
Yes, it is.
How do you process what we just heard?
Well, I think that it's the Fed acknowledging that the risks now are tilted for the labor market to be softening, and they want to head that off, especially because they don't think that tight labor markets are going to necessarily create inflation. That's a very good sign, and I think it means we have a dovish Fed again, and that's kind of a green light for small caps.
Small caps
and for equities.
They are working. Last I looked, small caps were up 3%. So is this what we need to really confirm the sort of broadening that comes and goes in the market?
Yeah, because I think that one of the things we should watch for is what happens to mortgage rates. But mortgage spreads are right now 360 basis points higher than the 10-year. Historically, it's 1.6 percentage points. So you could see a huge drop in mortgage rates. That's going to help housing, helps the financial small caps. And I think already the ISM, which has been below 50 for almost 30 months now, could finally go back above 50, and that's a good sign for industrials.
Although we had a discussion right on the heels of the speech about a little steepening in the curve. Is there a sense that the vigilantes are at least present, if not being necessarily vocal?
But we could also be steepening because growth expectations are improving as well. So this could be like what I'd call a bull steepening. I'm not really sure what the fixed income terms are, but I think it's actually a positive sign for growth.
The only real losers today are going to be some of the yielders and some staples. Would you be cautious on those?
That's right. I think that markets have been holding their breath. They've been getting defensive. That's why we've been bleeding for 5 days. And so now I think there's a relief and some capital gets put to work, and it's good for equities and risk assets.
So, all right, we need to make some news here, Tom. Everyone listens to you. We're at record highs now for the S&P and the Dow. How much more can these stocks rally?
I think there's a lot of upside, especially because, once you get an ISM back above 50, it really does argue for a broadening of markets. And I think one of the leaders probably comes from the financial sector. So I think, towards the end of the year, 6,800, 7,000 is possible.
Led by tech still?
Yeah, so I think you still want to play
this week.
Yeah, you want to be long AI and the crypto trade because those have been the market leaders. So the Mag 7, Bitcoin, Ethereum. But the broadening is really the financials, industrials, and small caps.
So you like them all?
Yeah, it's kind of cyclicals, AI and crypto, but not the defensives.
Your crypto calls have been getting a lot of attention lately, especially on Ether.
Yes.
Where we were talking earlier, we were debating whether it's the future of the financial system. A lot of people are thinking, people like you have said that.
Yeah, I mean, I think it's a really important moment happening this year with, the Genius Act, really greenlighting stable coins, and then Project Crypto, which is Wall Street moving on to the blockchain. I think it's a lot like 1971 when the US dollar went off the gold standard. That created the innovation of Wall Street because they had to sort of essentially create this synthetic dollar. Wall Street moving on to the blockchain is a bigger moment, and I think that's why Ethereum is essentially having its 1971 moment equivalent.
But a lot of people just see it as wild speculation and froth.
I'd say anytime something goes up, people tend to call it froth. I think they called AI a frothy trade now, but we know it has a lot of legs and it's been taking place for a couple years. Keep in mind, Ethereum is also the place where when agentic AI comes together, when you have robots and you want proof of human, you want to make sure those commands come from a verified source. That's all taking place on a smart contract. A lot of it will be Ethereum.
Tom, thank you. We just scratched the surface on that one, but we'll have you back very soon, no doubt. Tom Lee.
And again, that has been my view for a while now, that we would hit 700 on the SPY by the end of this year. So let me know your thoughts on this down below in the comment section. Hit that like button and subscribe to the channel if you have not done so already. Have a great rest of your day. Check out that link down below in the description of this video as well for the trading community. And I will see you in the next one.